All of you are probably in a situation where you've come, well, obviously for 2 or more years. And from a residency perspective, we look at 2 or more years as a good benchmark to determine whether someone's a non-resident. But be aware that there's no period of time that causes someone to become a non-resident. So let's say, for example, you came over, you start a new job, and for whatever reason, you were let go from that job, or there was a family crisis at home and you had to leave. You could come here, live here for 4 months, and become a non-resident again. And that's because at the outset when you came, your intention was to be a resident of Hong Kong and a non-resident of Canada. So there's no real duration of time, it's all based on your intent. But your intent is based on a whole bunch of factors in terms of residential ties that I'm going to cover in a minute. So within the whole concept of moving here permanently, we look at whether you can sever residency and how you can do that, and then the filing process as part of that, which I'll cover in a second as well. So the first item of ties is what we look at in terms of determining if someone's a non-resident or a resident. And there's 2 categories of ties. There's primary ties and there's social ties. Or sorry, primary ties and secondary ties. Now within the primary ties, we look at 3 different categories or subcategories within there. There's social ties, property ties, and economic ties. So let's say you come over to Hong Kong and you leave your spouse and children back home in Canada. You would not be able to be seen as a non-resident because you're not truly a non-resident in the sense that you've left a primary tie behind. So if you bring your spouse, you bring your children, you've severed your relationship with Canada from a social perspective. Now I know you all have family and friends and you might have parents or elderly parents. Those are not, they are social ties, but they're not direct social ties. So the only important tie are your spouse and then your children that are under 18 or under the legal age. So if you leave children behind to go to university, they're continuing to be residents, but you can become non-residents, even if financially you're helping them out. Now, the next one is economic ties. So let's say you leave your job in Vancouver and you start a new job here in Hong Kong. You've then severed that economic relationship with Canada. You could also look at material investments and property as ties, but that's kind of a separate concept when we look at this economic shift. So we look at where you're primarily generating income, and if it's from employment or self-employment income, then that would shift over to Hong Kong. The third one is our property ties. So if you maintain a home, if you had a home in Canada that is no longer available for your regular use, where you've either rented it out to a third party, or you were renting a home, so paying rent to live in a home, and you severed that rental arrangement, then that's no longer a tie for tax purposes. The only other way to sever a property tie is by selling the property. So if you were to relinquish the home in terms of selling it, then you'd become a non-resident from that perspective. So you can see that having any one of those 3 primary ties can cause you to be seen as a resident. What about these secondary ties? What happens in that category? Well, there's a whole gamut of ties such as bank accounts, credit cards, driver's license, provincial Medicare. I don't see any one of those ties as causing you to be seen as a resident because no one secondary tie can. You're looking at them as a group. So people say, well, what if I've maintained all of them? What you have to do is you really do have to work towards severing those secondary ties. But if, let's say, you kept a bank account and a credit card in Canada, it's not enough to cause you to be seen as a resident because it's just not material enough as compared to the primary ties that we talked about. One thing I do recommend in terms of the secondary ties that you should always sever is your provincial Medicare. So if you've got Medicare card from any of the provinces, you should forfeit it, and then be aware that when you move back to Canada, there's going to be a reinstatement period. So it's typically a 3-month reinstatement period, so you'll have to check with the province when you move back. And then just ensure that you're covered on some private medical coverage while you're waiting for that 3-month period. Now, so these ties, assuming you've severed your relationship with Canada, you're then in theory a non-resident of Canada for tax purposes. So then what do you do? Now the very first thing that's going to affect anyone that ever became a non-resident is this, and I'm just going to bring up the internet. This is a regular T1 return that is filed in Canada when someone becomes a non-resident. It's the same return that a resident files. But in the year that you become a non-resident, you file what's called a departure return. But it doesn't look any different, it's the same return. And the difference is in the section down here called information about your residence, you would enter the date of your departure in this category right here. So that lets the Canada Revenue Agency know that you've gone through the process that I just talked about in doing your own self-assessment of your situation to determine that you are a non-resident because your ties are limited. There are a whole bunch of ramifications or things that could occur on a departure return depending on your circumstance, and I'll talk through those in a minute. But the departure date is one. That would apply to everybody that ever left. And the second part of that is there's a proration of personal credits for the period of time you're a resident. So during the time that you were a tax resident in Canada, all of you received approximately $10,000 as a personal credit for federal and provincial purposes. That gets prorated for the period of time you're a resident in the year of your departure. So those two things would occur for everybody. Now, what are some other common things that would happen when you become a non-resident? Well, I'm going to talk about some categories that everyone's kind of got to look at. Now, the first thing is obviously you severing the ties, but is there anything else you would need to file other than a departure return? Well, a couple of years ago, I would say no, because it was really just you self-determining your residency status, filing the departure return, and then taking into account any departure implications of you becoming a non-resident. But what we found in the last year is that the Canada Revenue Agency has been requesting a form called the NR73, which is a determination of residency form, so you can just look it up on Google. It's called NR73. And basically what the form does is it allows you to itemize all the ties that you have to Canada, and the CRA would use that to provide an opinion as to your residency status. Now, anyone filing a return or a departure return that has a departure date prior to the 2010 calendar year, it's highly likely that the CRA is going to write you a letter saying, please provide us with an NR73 to determine what your status is. It's a new thing that they've been doing recently because I think they're starting to try to become more strict in terms of their assessment of whether someone's a non-resident. So it's important that you feel that you've properly severed your relationship with Canada. Now, what else happens on a tax return when you depart? A common thing is something called deemed disposition. So what is that? Let's say you buy shares in Microsoft at some point in the past while you're a resident of Canada. You bought them for $5. And on the day that you depart, they're worth $7. Well, Canada wants to tax you on that $2 of accrued growth, only because had you been a resident and you one day sold those shares, you would have paid tax on them. Canada's saying we're not going to tax you in the future if you sell them as a non-resident. So if you sell them for $10, Canada doesn't care, but they do care about that 7 minus 5 differential, whatever the value was as of the date of your departure, or if you've got a loss, then you're going to realize a capital loss on your return. Now, that's strictly for assets outside of registered plans. I'm going to talk about RSPs and pensions and other assets later. Now, what else would you need to do if you become a non-resident? You need to inform Canadian payers that you're a non-resident so that you're aware there's really kind of 3 categories of income you could earn. There's capital gain income, there's interest income, and there's dividend income. Capital gains after the date of your departure, which we just talked about, is not subject to tax after you've calculated the deemed dispositions. And again, those are outside of pensions and RSPs. Interest income is not taxable to non-residents. So if you have a deposit with a bank and you're earning 1% interest or 2% interest, none of that is subject to tax for non-residents effective early 2009. But what you do need to do is you need to inform your financial institution that you're a non-resident, and they're then going to register your account as being held by a non-resident and issue you what's called an NR4 slip. So it would replace your T5s or T3 slips that you received in the past. And the NR4 slip basically shows the amount of interest income you earned and no tax withheld because it's not subject to tax. But dividends are. So back to the Microsoft example, if you continue to hold those investments in Canada, which you can as a non-resident, then those dividends would be subject to a flat 25% non-resident withholding rate. Now the 25% is because you're in a non-treaty country, and I'll discuss the treaty in a few minutes, but that's just a flat withholding tax. It's a final tax, and there's no other obligation from there to file a return relating to the dividends. Now the final common one, and this list kind of comes from common questions that I've been getting for the last 10 or 11 years, but the final one is relating to the principal residence. So let's say you formerly lived in a home in Canada and you depart, you've got to make a decision at that time as to how you're going to treat the principal residence exemption, because there's really two options, which I'll talk about if that comes up as a question, but I don't want to bore you with it, otherwise you're going to glaze over. But when you depart, what happens is there's a change in use of the property when it converts itself from personal use to income producing. And when that occurs, up until the date of your departure, you're able to claim the full principal residence exemption. So none of the gain up until the date you start renting the property will be subject to tax. But all of the gain for the future, when you're a non-resident, would be subject to tax. That's one option in the whole scenario of the principal residence exemption. The other option is that you do an election at the time of your departure. So it's really due by April 30th of the year following the year you depart. And you can elect to have the total gain over the lifetime of the property, so the difference between what you eventually sell it at minus what you purchased it at. That total gain can be prorated for the years you did live in it as a tax resident, and that component will be exempt, and the remainder would be subject to tax. So it's a decision that's typically made in the year that someone departs, and so it's important that you think about the whole concept of the principal residence and how it might impact this eventual tax on the sale of your property. So back to what I was talking about before about relinquishing ties in terms of your property, and this is the most common area where people say, I lived in a property in Canada, I've now departed Canada, can I sell it or do I rent it? Well, that's up to you, and there's financial implications for both, but let's say you do go the route of renting it. What are your obligations, or what if you purchase a rental property as a non-resident? You've got to be aware that there's an area of the Income Tax Act that requires you follow non-resident reporting and withholding requirements in relation to property. Now, withholding on a property is a requirement irrespective of whether you earn a net income on the property and owe income tax. So what I mean by that is if your revenues are greater than your expenses, you're going to have a net income, and that net income is going to be subject to tax. It's going to be subject to the same graduated rates a resident would pay, but just on the net rental income. Let's say you're in a rental loss. The most common question I get is people call and they say, I've owned a property for 5 years and it's at a loss, so I've not done anything. I haven't filed a return, I haven't sent in any withholding tax. Am I okay? Technically, you're not okay because you're required to remit 25% of the gross rent on the property as option A. There's two options. So option A is you do the gross method basis where you remit 25% of the gross rent. The second option is where you remit 25% of the net rent. And so that's called the net method basis, and it requires that you submit in advance a projection of what you think the property's net income will be. So you file something called an NR6. And once that's approved by the CRA, you can then send in 25% of your net rent. So let's say your net rent is zero because your mortgage interest, property tax, utilities equal your rental revenue, then conceivably you wouldn't be sending in any withholding tax at all. Now, this net method basis, something I've changed in my thoughts over the last couple of years is that if you've just got one property, it's probably best that you follow the gross method basis because you can administer it by yourself. And there's really no penalties for not following all of the steps as long as you've remitted your withholding tax. But under the net method basis, because you're requesting approval not to remit withholding tax or just remit on 25% of your net income, I do recommend that you get an agent in Canada, someone that does this for a living, that handles rental properties for non-residents, and they would follow the NR6 process. The reason is because the penalties are so stringent. So if you don't file your rental return by June 30th of the year following the year of rental, there's a 25% of gross rent penalty, which is quite severe. The other penalty is the not filing the NR4 slip by March 31st each year. So that's also a cumbersome penalty if you're following that second option. So again, if you've got more than one property though, I think the net method basis is good because let's say you were generating $100,000 of rental income, 25% of that would be material in terms of cash flow. So you would want to gear yourself towards going the net method basis, but in that case you should really hire an agent to handle the property anyways.